Okay, everybody, welcome back. We're going to do the mortgage market and loan types. We got 5 lessons to get through. Secondary mortgage, loan types, buy downs. If you need assistance with any of this type of stuff, stay tuned on this video. We're going to go through it, and hopefully you'll have a better understanding in about 20 minutes. These videos are about how the mortgage market works. Mortgage market is made up of primary, secondary markets, which are controlled and regulated by the Federal Reserve System. Federal Reserve System, also called the Fed, divides the U.S. into 12 Federal Reserve districts. All national banks have to be a part of the Fed and must purchase stock in the district banks. The primary mortgage market is where the banks originate and operate. They have the cash, the loan, the borrowers. The players in the primary mortgage market are the borrowers, the homeowners, the lenders, the credit unions, the savings and loans. That's the primary mortgage. The secondary is primary lenders don't want to hold on to the loans because they run out of money pretty fast if they wait 30 years for borrowers to pay these loan backs. They need their money a little quicker, so they earn a profit by keeping money moving in and out of their system, which sounds like mortgage brokers to me. Secondary mortgage market, because they keep money moving and they can't have 30-year mortgages. How the markets work together. Most lenders want to sell their loans to the secondary market as quickly as possible, and then the secondary market will try and get rid of it to the bigger banks. Any mortgage loan that meets the standards of conforming loan. The secondary market wants to buy the loans that are reasonably safe investments. The Fannie loan, Freddie Mac, these are the major players in the secondary market. Okay, never mind on my brokers then. The brokers are not the secondary. The secondary market are our Fannie Mae and Freddie Mac, which are like the VHA loans. If it's a safe one, they'll take it, and they will, if it meets the standard of a conforming loan, and they will buy it. Additionally, standards include loan-to-value ratio and the borrower's credit score. So all that has to be in play if you're trying to get a secondary mortgage. Due to the mortgage crisis, which happened, 2007, something like that, in which questionable lending standards contributed to the problem, is the ability to repay rule. It's the ability for the lenders to make a qualified mortgage so that people have the ability to repay. It's not going above and beyond and lending out more than they can handle. So let's go back over here to our questions. Controls money available and what banks can charge what for the money. It's probably the Federal Reserve. It maintains the balance by regulating the flow of available funds. It controls money availability and what banks can charge for that money. That's my thought. All right, where banks that originate loans operate, probably the primary, and they're sold, held, or serviced in the secondary. So there we go. Okay, so the feds want to avoid a couple things to maintain a balanced economy. What 2 things do the feds try to avoid? I would runaway inflation and serious deflation. Okay, so runaway inflation and serious deflation they're trying to avoid. An attempt to maintain a balanced economy, which 2 of the following items does the Fed regulate? It maintains this balance by regulating the flow of available funds and interest rates. What does this have to do with real estate, right? Simply, if it's more expensive for banks to borrow, it makes it more expensive for consumers to borrow. And when borrowing is more expensive, there are fewer consumers borrow. And if consumers aren't borrowing, they're not buying as much, and you're going to see fewer vehicle and home purchases. That's why all this stuff kind of goes together. All right, secondary mortgage market players, which I believe is Freddie Mac, Fannie Mae. It's important for you to understand. It's common for lenders to sell the mortgage they worked hard to obtain. And why do lenders do this? Some lenders carry their own loan portfolios, which means they don't sell the loans they write, but most want to be able to free up their funds to make more loans. So they do this by packaging and selling loans on the secondary market to like Freddie Mae and Fannie Mae and Freddie Mac. Okay, so why do lenders do this? Because they want to free up their funds to make additional loans. All right, conventional FHA and Royal Development loans. We talked about some of this on the last video. I don't think it's Farmer Mac. I think it's... Okay, conventional FHA. I guess there is a Farmer Mac. Farmer Mac. Why didn't we just call Fannie Mac too? All right, anyway, let me get back on track here. Conventional FHA. I have no idea. Agriculture and Royal is Farmer Mac. That's easy. FHA. I don't know. I thought it could be either one of them. All right, I think it's Freddie on this. I don't know. No, okay. Freddie is the little brother. Okay, so it would be Fannie Mae, Farmer Mac, and Freddie Mac. Right? Okay. So you think of Freddie as the younger brother. Okay, that makes sense. All right, loan types. All right, let's look at this. Adjustable rates, amortization, balloon, fixed rate, growing equity, pledged account, straight line. A loan that fluctuates with a rate based on the economic index is associated with what? I'm not doing none of that crap. Okay, let's see. A line that fluctuates with the economic index. Adjustable rate. Okay. Debt that is paid off by making periodic payments. I guess that's the amortization. Periodic payments of principal and interest. Mortgage where installment payments change. Installment payments change. So straight line, they're the same. Has to be amortization. But we can't use the same one twice. Okay, graduated payment. Monthly payments increase over time is growing. Usually up. Fixed rate. And there is no negative amortization. Graduated payments. Straight line increase to a set schedule. Okay. What increases over a pledged amount? Type of graduated payment. Buyer deposits into a savings account. Okay, so this one here is pledged. All right, growing equity mortgage. The monthly payments increase over time according to a set schedule. I don't know how in the world we're going to remember all these different things. So this one is growing equity. Okay, now straight line or graduated payment. It gradually adjusts, usually upward, is graduated. Okay, and this might be straight line. Let's see. Okay, we only passed this because we're looking over here at this chart, because there's like no way I remember all these different things. The main ones that we'll be using are adjustable and straight line. All these other ones I've never seen in my real estate career. Okay, as your resource states, a wraparound loan. Let's see if we can find wraparound loan. This is a form of seller financing in which the seller's mortgage remains in place, but the seller is receiving payments from the new buyer financing the purchase. The mortgage payments the buyer makes are expected to be higher than the payments on the seller's original loan, and it's generally a regularly short-term arrangement. Mortgage type where there are two properties that are pledged as security. Blanket. Mortgage types that allow the lender to share part of the profit. From commercial property. I guess this is package, which is personal property included with real estate. It's mainly in commercial. Okay. Sellback leasing provides 100% financing and allows the investor to realize the tax benefits of real property ownership. Okay, well, a security of owning a building with, generally speaking, solid tenants. Let's look at an example of sale leaseback financing arrangement. And immediately leases the space back to Jeff. Okay, this is an example of a sale leaseback. Probably because he can't afford it, but he wants to stay in that spot, so somebody else is helping him out. Kind of like an investor. All right, financing in which the seller gives the buyer a mortgage toward the purchase of a home. I think that's wraparound because we talked about this a few times. Purchase money. Let's see what purchase money is. Gives the buyer a mortgage toward the purchase price. All right, that's purchase. This is wraparound. Okay, almost similar. The seller gives the buyer a mortgage towards the purchase price. All right, that's the difference. If they're giving them a mortgage towards the purchase price, it's purchase money. And if they're just taking their payments and the seller keeps the mortgage in their name, but they're taking payments from a new buyer. I guess that's kind of like rent to own almost. Okay, loans taken against the equity of the house. Home equity loan, I would think. I don't see this on here. Here it is, reverse mortgage. So this is usually for older people to use they want to stay in their homes. They use their equity to stay in the homes so they can keep up with their payments. But, in a wealth building channel, we're not going to promote this kind of thing here. We want you to keep working until you pay off your mortgage. You don't want to quit working while you have a mortgage. You want to try and pay off your house before you retire. Taking out another mortgage when you're like in your retirement is crazy, and you're going to have the stress of having to pay the bill. Okay, these flashcards will be on another whole video by themselves. So if you like flashcards to study, they will be on a separate video by themselves. Okay, this kind of thing you see when you get your loan package. It's going to break everything down if you keep the life of your loan for so many years. Most people end up not selling or moving before they even ever finish. So it's going to have your principals, interest, cumulative interest, you know, how much you're paying, how long. It's going to break it down all by your years here. It's just giving you an example of what it looks like. What information can be found on it? Okay, so we'll have the interest rate, ending balance, this one, the loan term, and loan amount. So they usually have a lot of information on them. Most people never get to that point, though. All right, buy downs. All right, let's talk about buy downs. What is buy downs? It's a lump sum prepayment of interest to the lender at closing that buys down the interest rate to below the market rate, either temporarily or permanently. Most buy downs are temporary. I personally have never heard of this. Sometimes the lump sum prepayment is instead of the cost of the loan. Buy down advantage. The advantage of this is it helps the borrower qualify for a larger loan but keeps the housing payments lower for the first few years. So the borrowers can opt to temporarily pay down the interest rate, and that way to do so because they can't qualify for a mortgage payment at the going rate. So it looks like the interest rate starts off low and then keeps getting higher. Lenders can't do this without the borrower's express permission. Keeps the housing payments lower for the first 3 years, I guess, until you get your stuff together. All right. It doesn't say anything about points in here. So that it's like a borrower lender discount points. Doesn't say anything about points in here. So I don't know why they're asking this. I have no idea. Let's just click on one of them. Okay, try again. All right. It doesn't say anything about points unless I'm missing it. So that's really, I don't even know why they're asking that. But anyway, that's that. All right, land contracts and seller financing. We're on our last lesson here. All right, if traditional financing isn't available or isn't desirable or the buyer can't meet the lender requirements, then this may be done through a land contract, which has nothing to do with vacant land or purchase money. It just has to do with somebody getting a loan. Seller financing can be provided, and it's called a land contract. So if they have trouble getting financing, you can get seller financing if they can do that. The seller agrees to provide credit to the buyer for a portion or all of the funds, and the seller agrees to provide financing. Sometimes the sellers have trouble selling a property, and they don't need the cash, would prefer the income, and so that's why they sometimes do this. While the buyer is making payments, the seller is the owner, and the buyer has possession and equitable title. and the seller retains ownership, and in most cases buyers cannot even sell the interest without the owner's permission. So until they pay off whatever they need to pay off, the buyers, the seller has pretty much control of the property still. Some sellers have used this arrangement to take advantage of naive buyers. For sure, if you don't know what you're doing, they can really rip off a buyer. The buyer might pay for years and miss a payment, and the seller would cancel the contract, retain the title, and sell the property to somebody else. Recognizing the difficult position that land sales contracts put buyers in, some courts will recognize the buyer's equitable interest in the property and offer the property after as little as 1 year making payments. They would require a statutory process for the seller to reclaim the property. Yeah, so I definitely, I could see that being a potential nightmare for a buyer. An alternative to the land contract is purchasing a money mortgage. With this arrangement, the buyer is able to obtain a loan for part of the purchase process, and the seller agrees to finance the rest. Often the banks will sell the property in foreclosure and give the original seller part of the proceeds. So a third way to assist buyers in the second mortgage is for a portion of the money down. So if the property were $200,000, the seller agrees to sell for $150,000 and retains a $50,000 second mortgage, leaving the buyer to finance and provide a down payment on only $150,000. The lender is first, and then the seller is second. The land contracts and purchase money mortgages are two types of seller financing, but they have some differences. The seller retains title in a land. The buyer retains title in a here. The seller retains ownership while the buyer has possession. The buyer places security interest in the property. Okay. So both of these are very risky for a buyer. I mean, I would hope in our wealth building channel here we don't get to the point where we got to go to a seller for financing. We're going to get our credit scores up, get rid of our debt, so that we can go in and get a normal loan, a mortgage loan from a bank instead of a seller. Okay, so just remember that we are going to do the flashcards on a separate video, and we're also going to do our unit exam on a separate video. So if you're following along and you want to take the exam on what we just covered here, on all these different secondary mortgages and mortgage markets, it will be on the next video. I thank you all for watching. Stay tuned.